Hello and welcome to a new update. So, scalping has been going really well. You can see here 28% profit in the last 2 weeks. So a little less than 2 weeks actually. By Friday it will be about 2 weeks. Drawdown really low. So today I'm going to talk about my strategy, what I use, and how trades work, how they go in and go out, and the profit potential and also the risks that are involved. So hopefully you enjoy this video. And I'll get a little bit more into the details. And I introduced what I was doing in my last video, so if you haven't checked that out, I recommend doing that. All right, so 28%, 5% drawdown, and I'm going to briefly go over what's been happening this week. So today, 1.74%, so really good, and 69 pips profit. This week, 6.2%, and I've been able to come out with about $60 profit. So how does this work? This is a Bitcoin account. So this is a Bitcoin account, and it's really easy to figure out how much money that you're working with. So right now, if you put in at bits to USD, 177,588 bits is actually $1,083 in US dollar, as in US dollars. So it's not a huge account, and the reason why that's not a huge account is because I'm testing it on the small account before I bring in the bigger funds, which is around $9,000, $10,000, which should be hopefully by sometime next week. I had an issue with a wire transfer, and so I'm having to wait longer for that. Okay, so back to the results. All right, so 6.22% on $1,000 is roughly about $60, so it's not huge. But so far, going very well. And you can see that the average win is 5.87 pips and the average loss is 10.37. So how does that work when I'm profitable, but the average win is a lot smaller, almost, you know, the average loss is almost double the size of my average win. And if you look at the win rate, it's a 70% win rate. And so that's one reason why the average win being smaller actually can work. But it's because I'm using a semi-martingale strategy. So with my risk management, I'm doing 0.1 lots, 0.15 lots, 0.2, and so on and so forth. So it's not a double every single trade. So it's not 0.1, 0.2, 0.4. It's not like that. So this is not what I'm using. A semi-martingale strategy is much safer in my book. It's still a lot more risky than your standard grid trading, but if it can work with certain strategies if the risk is low enough. All right, so the lots are pretty high, and it's because it's semi-martingale. The commission is also high because of the amount of trades. So 350 trades in the last 2 weeks. And the best trade and the worst trade. So my best trade is going to be much higher because of the martingale again, which is great. 70 is about 70% win rate on the long and short trades. And the cool thing, and one of the things I love the most, is the 41-minute average trade length. That's really short, and that's exactly what I wanted with this strategy, is to be in and out of the market as quick as possible. Okay, so next, I'm going to go to the charts, and I'm going to show you a little bit of the trades that have happened already, or just today. You can see that it's traded, my expert advisor has traded a lot. You can see all the blues are the buy trades, and the reds are the sell trades. So buy, buy, sell, and sell, sell, and then all these are buy trades as well here. Okay, so what's this indicator that I'm using? So I'm going to briefly talk to you about the TMA indicator. It's the triangular moving average. So what that is it's the triangular moving average, also known as the TMA, is similar to other moving averages in that it shows the average or mean price over a specified number of data points, usually a number of price bars. However, the triangular moving average differs in that it is double smooth, which also means average twice. So you can see that it kind of follows the mean of the price, so where the average price is, and it shows you price and how it reacted to that middle line. So the idea is that when price starts to pick up in volatility, it will move down and hit this green bar. which is I guess the bottom of the channel here, and this is the top. And when price gains volatility and moves down to the bottom green, I look for somewhat of an oversold condition where prices move down really fast, and I'm looking to buy into the market for it to have a small pullback, or a sell at the top if it moves down, and looking for a pullback on the top side. So a lot of times what happens with price is that if it moves quickly down in one direction, it will have a small pullback quickly. And the same thing happens in on the higher time frames as well. That's what I am. I'm a counter trend trader. So I look when price moves is trending in one direction, I look for that pullback. So this is a very M1 or a very scalping way of doing what I've done in the past, which is uh, this strategy originated from a friend of mine. And I have always called him sort of my mentor. And it's actually his strategy using this kind of indicator. So hopefully he's okay with me sharing a bit of it on YouTube. But he came up with using this strategy on the M1 with the TMA. Now trading it in the management, the multi-management, and how to trade it is quite a bit different than what was intended. Um, and how it was intended to be used was take a dollar amount of profit, or roughly 5 pips on each trade. But you can actually change that to be 3 pips, as little as 1 pip, all the way up to 10, 20, as much as you want, really. But the smaller the amount, the safer the strategy is. So it's actually adapted and changed quite a bit since the original one. And you can see here that I have all of these TMA news, TMA EA. I have about 20 or so versions of this expert advisor over the last 3 years, and I've heavily modified it since then. All right, so when price moves up to the top, I look to sell. When it moves to the bottom, I look to buy, and it's a repainting indicator. The TMA and triangular moving average is a repainting indicator. You can find some that are not, but I still am able to utilize the repainting in a profitable way. So it looks quite a bit different. So this trade here, the sell that you see here, was actually taken 1 pip above the red line when price moved up. So the volatility kicked in and price moved at 1 pip above this red line, and I entered to sell. But after that, what price did later on, the indicator changed to match the average price or the mean, and so it changed the way it looked. But I was still able to come out with a profit by entering trade 1 and then trade 2 up here at the top, and then found that pullback that happened with price. After a increase in volatility on the upside, there is typically a pullback that happens. And it needs to be small. Your profits need to be small. And that's why this is a scalping technique. All right, so I'm again here we have 1, 2, 3, and 4 trades, and they all did end up getting that pullback. So number 4 was the last trade that bounced up from that point and did have that pullback. So abrupt move down and then quick move back up, profit taken. So each trade has a stop loss. Each trade. So trade 1, 2, 3, 4, 5. Every single trade that's entered into the market has a set pip stop loss. You can have that changed if you want to modify the strategy yourself. And you can have it be anywhere from 30 pips to 100, and it just depends on your risk level, how much you're risking per trade, what your grid size is. My grid size I found to be best to be in the 10 to 20 bracket. So if you want to make this strategy grid trading, I find that 10 to 20 pips is probably the most secure, at least on the Euro US dollar. I've tried this strategy on the pound US dollar for a little bit, and it shows profitability, but it's very takes a long time to do testing with this expert advisor. And so I've mostly spent my time with the Euro US dollar and modifying it to really be solid on that pair. So later on, I'll try it on all the other majors like the AUD USD, the USD CAD, the USD Japanese Yen, but haven't really gotten to that point yet. maybe I'll find even a better pair than I am using right now. I like the Euro US dollar because the spread's really low. And I'm using it at Evolve Markets, and I find this broker to be really great, but they only allow for cryptocurrency deposits, so like Bitcoin and a Litecoin, Ethereum, and there's benefits to that, and there's also weaknesses. And the weakness is that this is the price of Bitcoin that you see here, Bitcoin versus US dollar. And Bitcoin has been going down recently, so it's been hurting my investment here. And it can go against me and it can go for me. So Bitcoin's on the rise, that could really help my gains each month. But if it's going down, then it can really hurt things. But luckily, since I'm dual investing here, so I'm actively trading this account, and it's also a Bitcoin account. Once things are going in the positive direction, then I'll be in a really good shape. And if one is not doing so well and I'm doing very well in the other, then I can kind of balance out. And so it's a workable investment plan. If will I use it with later on with the potentially 10,000 down the road? I don't know yet. But my $10,000 account or $10,000 fund, it should be coming into the account sometime next week. I had a wire transfer problem that's postponing that. So all right, so let's get back into the trades and what they and how to utilize this. So the TMA is a really good indicator, and I've tried this strategy and have tested over since 2015. So 2015, 16, 17, and 18. Uh, and so that's 3.5, 15, 16, 17. Yeah, 3.5 years of testing that I've done. Now 2014, just not that great. Multiple losses in 2014. And I've modified my strategy to work very well with no losses in 2015, no losses in 2016. Well, when I say no losses, I mean no margin calls. It has had some losses, upwards of 10 to 20% once, maybe twice a year, but there were no margin calls in 2015, 6 and 16. Now 2017, there is an issue. And that is in November of 2017, there was a substantial loss, and it was actually a margin call. So I'm going to talk about that margin call with you now to show you what happened with the price to actually cause a loss. Now, I've been trying to modify my strategy to work with this loss, to see if I can modify it to have it not lose during this time. I was able to do that in 2015 and 2016. Originally, I was using a 10 pip take profit per trade on the strategy, and that worked very well in 2018 for the last 6 or 7 months. But it caused issues with the 10 pip take profit per trade in scalping, caused issues in 2015, 16, and 17. And it had one loss in 2015, two losses in 2016, two losses in 2017, and no losses in 2018. But I needed to try to cut those losses out because I want the strategy to, it's going to remain risky no matter what, but to try to cut and pull back on that risk as much as I can is a really important thing to try to protect my funds as well as possible. So 2017 in November, I'm not able to get rid of this loss. And it's just something that's potentially going to happen in the future, where I could have another margin call on the account. So how do I deal with that? Well, since this is a high risk strategy, it's also high reward. So I'm making anywhere from 20 to upwards of 30% per month with this strategy, and so I'm able to take my profits off the top each month, depending on if I want to wait for my account to be doubled. Do I want to wait for it to hit 50%? Am I going to take the profits off the top every single month? If it's 20 or 30%, just take that right out. But it's going to be a strategy where I will take out some of my profits over the coming months to help protect my balance, just in case I do have a margin call. Okay, so let's get into this trade here, so I don't, I'm not taking this video too long. All right, so you can see that the original orders here, 1 and 2, were really good. So those were instant profits, and then this is when it started getting bad. Must have been some news or something happened, and price went on a huge spree up. Now the idea with the strategy is that when the there's a volatility moves up, and then there's a pullback, right? And that's what I've mentioned before. There wasn't really much of a pullback to take the profit necessary here. You can see that it ran really up, but I do have a stop loss on each trade, and they were closed out. So trade 1 right here closed out for a loss right here, and then trade 2 closed out for a loss right here, and then so on and so forth. And they keep closing out, and this starts going down, down, down until it eventually wipes out the account. Because we have a semi-martingale, so each trade is increasing in risk slightly, and looking for that pullback, which never really happened. Now there was a small pullback, and there was a big potential for a pullback. You can see the price kind of went in this small, slower down movement, but wasn't enough for me to come out and profit. It needed to move down a little bit further, and didn't happen. It shot back up, and more trades were closed out, causing this to have total loss. Now that is the risk with this. And now that's probably going to be a big turnoff to you with me showing you this one big loss. But it's important to understand how this strategy works. And you can show you previously. Let me take off the grid on other. Great, how the strategy works with closing out trades. So you can see that right here. Okay. I'm trying to find a point in price where trades will close out for a loss. Okay, here we go. All right, so you have price moving down, all the buy trades here closing out for loss, but it's entering new trades at higher risk. You can see this one right here and this one right here ended up coming out into a bigger profit and closed out for profit here. And the same thing with in previous times. Okay, so this is not the best indication here. Okay, so some of these previous tests that I'm trying to show you, not finding the best. Okay, here we go. Finally. Sorry to make you wait. I hate having dead time in my videos, but I want to find the perfect example to give you an idea of what this looks like when it does work out. So first trade, second, third, fourth, fifth, sixth, and seventh. So all these trades, or this one here, ended up closing out. You can see it was closed out here. All these other ones, a couple of these other ones closed out. Number 2 closed out right here. But trade 3, 4, 5, 6, and 7 closed out for profit here. And the profit from the winning trades, so 3, 4, 5, 6, and 7, were able to make up and exceed the loss from trades 1 and 2. And that's why I have a stop loss on each trade using Martingale, with the hopes that the pullback will eventually happen and I'll be able to make up for those losing trades 1 and 2 with trades in the future. So if that doesn't make sense, I'm going to show more videos coming out probably next week, give you guys another update on how this is going. So the TMA is a good indicator to use for scalping because it shows you what price is doing in the here and now, and when price picks up in volatility, what to do as well. So guys, that's pretty much it and what I wanted to show you for this video. Keep in mind that the strategy has had one loss since 2015. So 3.5 years of time, it's had one loss, and that was in 2017. So we're talking about 20 to 30% on average per month using the strategy with just one margin call in 2017. Now, because of that margin call, it makes me trade it this way, where I have to take out profits each month or every few months in order to protect my investment. All right, so hopefully this video series will continue to follow along my progress on scalping the market, and hopefully things continue to go well. Thanks guys for watching, and I'll see you next time.